Welcome to Alpha Bytes. I'm your host, Marconi White, and we've got a show hotter than Nick Carter's take on seed oils. That's in fuego. I'm going to ask the guys whether Bitcoin, Ethereum, or something else is going to win the prize for AI and alien usage. But first, Fitch downgrades U.S. debt for the first time since 2011. Is this bullish for Bitcoin? Ben Lilly dives into the growth of the Treasury account at the Fed. JJ asks if the whales are still buying the dip. And King Kodi, well, he's going to ask whose fault it is for Curve's potential collapse. And even worse, the potential for wrecking the DeFi ecosystem. And we've got a lot more in store, much more to cover. I've got Ben Lilly, JJ, and Kodi in the studio. Gentlemen, welcome. We're going to kick it off with a market update. But before we do, our producers, well, they've introduced a change to the show, and they're calling it the shot clock. And it works like this. During each segment, you're going to hear 3 buzzes. The first buzz happens after 90 seconds, the second after 5 minutes, and the last one when the segment is going to wrap up. That's a nasty one. But after the final buzzer, I'm going to have to cut you off because we're going to have to move on to other areas of alpha on the show. All right, those are the changes. Let's get started. JJ, as I mentioned, we had the Fitch downgrade U.S. debt. You're looking at the charts. Tell us, what's the market update? Where's Bitcoin going next?
Hey guys, good to be back. So my punchline for today is it's chess, not checkers, which basically means that every time that we see price kind of hint that it's going to break out or break down from this range, we see people trying to front run it with perpetual contracts in either direction. So that's people either coming in on the short side, as we saw yesterday, and then inevitably getting squeezed out, or on the long side, as we saw last night into this morning, people trying to front run that break to 30K before the spot market confirmed it, and obviously they get washed out. So market makers seem happy to just keep playing this range and keep ping-ponging price back and forth. Market's kind of a complex adaptive system right now, which means that when those liquidity pools are placed there, the market's just finding a way to continually take them. So what we saw yesterday with BTC is it bounced clean off the 100-day moving average, which was at 28,500. And then it worked its way back up over the 50-day moving average, kind of teased that breakout to 30K, but quickly reversed. What we saw there was really DXY bouncing back strong, and I think that kind of put a cap on the Bitcoin rally last night. So now DXY is actually back over its 50 and 100-day moving averages. We saw a lot of dollar shorts flood into the system in early July when it broke down below 100. Then obviously we have kind of these overhead macro risks. Like you mentioned, the U.S. government's credit rating went down. That's kind of causing a flight to safety right now, which is the dollar. We see some signs in legacy markets that they could be coming under stress, with the VIX, the volatility index, rising up over 16% today. And that's kind of a gauge of fear in the market, fear and liquidity. So as of right now, the dollar is beginning to look a little bit overbought. I would be cautious stepping in front of it because it could turn into a freight train if it gets above 103.65. And that would be kind of the dollar milkshake theory, where you just see all the liquidity flood out of markets. Bitcoin would not be spared, and we'd see a total wipeout. But just looking for a reversal. Once the reversal, then we should be clear to proceed back above 30K. So that's kind of what I'm looking at now. Mixed signals. So just waiting to see how the day shakes out in the New York session here.
So you're expecting a reversal on the DXY to the downside to allow Bitcoin a little breathing room to move back up?
Yeah. So right now, there is a bearish divergence on DXY, which is showing that its RSI is higher and its price is lower than it was in early July when it made a high around 103.50, I believe. So that's an encouraging signal, but obviously you need to see these things play out, and that would mean DXY has to fall back below around 102 or so to really confirm that that pattern is playing out. You don't want to jump into the freight train and call the top on it while it's kind of moving the way it has been over the past couple of days here. So cautiously awaiting reversal, but by no means calling a top there.
Cautiously awaiting a reversal. I mentioned that the debt was downgraded, and we were talking offline about the impact. The last time that happened, I believe, was 2011. Did you have time to look at the pattern there? And does that give you some idea of what may happen to the DXY?
I did, but it's a bit of an apples and orange comparison, I think, just based on the different time segments there. Like at that point, we're at the bottom of a 3-year bear market in the DXY, and now we're just kind of ever so maybe 10% below the lows of 2022. So from that aspect, there's not a whole lot to gauge from it. But I do think it is causing a bit of risk off in markets. Like I mentioned, the VIX, the volatility index of legacy markets, is up huge today. So it's really kind of scaring money out of investments right now, which ironically is into the dollar. And if the U.S. government is not a credit-worthy borrower, they're going to devalue the dollar. So it's kind of a circular thing there, which would make the dollar extremely strong in the near term and then much weaker in the long term. So it's just waiting for that to play itself out one way or the other.
Okay. Ben, I want to get your thoughts here. You've talked in the past about the ability for the Treasury and the Fed to work together to kind of engineer the soft landing, and a lot of it has to do with debt. What is your perspective? Have you digested the information of Fitch downgrade? Do you think it matters? Is it more of a moot point? What's going to happen with the actual pricing of debt going forward with some of the charts and some of the data you've been looking at?
Yeah, it's a good question, and always good to have you back, by the way. JJ, always enjoy listening to your market updates. And when it comes to that question on this downgrade, I think it actually works in terms of the yield curve in its favor, because if they're going to have to issue some debt and they want to keep those yields relatively high, they need to attract some buyers. So rising yields will help even normalize that yield curve even further. So while the headline news is pretty terrible in one sense, we should consider the fact that this might actually play out to their favor.
That's an interesting perspective. I would imagine most market participants were waking up a little gloomy, but you're saying this may actually help with their engineering of the soft landing?
Yeah, you look at those 10, 20, 30-year yields, and they're well below the federal funds rate of 5.25%, 5.5% right now. And to keep rates and kind of like the financial plumbing intact, you really do need to have a nice, smooth yield curve that is essentially logical in thinking, where you want to borrow for longer periods of time, you should be borrowing at a higher rate. And if they can normalize that curve and keep it all well above the federal funds rate, that keeps kind of rates in check throughout the system.
What's interesting there too, just to add in, is the bond market's just been getting absolutely slaughtered. Like TLT is now at 96 it's trading at, which is, I have to pull up the chart to see exactly, but the lowest it's been in quite some time. So it seems like that's kind of, there's just signs of stress that you're really seeing in markets right now. That was a big gap down in TLT this morning, lowest it's been since November of last year. And it's just kind of fading.
That's a good reference point, because if you actually pull up rates of late, especially the 30-year right now, it's getting ready to go parabolic. So TLT is only beginning to probably see that move.
How that unwinds, right? Like somebody is long these bonds. So like, what is their like? At what point do they puke out of this, and like how bad does it get in the bond market, and what is the eventual? Is there intervention there, like we saw with the gilt market last year? How does that reconcile itself, because somebody's inevitably holding these what appear to be toxic instruments now?
JJ, you're asking about yield curve control?
I'm asking about the bond market, essentially. Like how's this going to rectify itself when you have what amounts to be bad debt, apparently, if they're going to go with higher for longer here indefinitely, and you have all these people back holding the bond market. At what point do they puke out, and what happens to markets when and if they do?
Yeah, that's a good question, because a lot of people got caught off sides with the way that yield curve changed shape when rates were starting to rise at the speed at which they were rising. Last year, those may be going, long on the long end and short on the front end, or vice versa. All these really high leverage positions that take place. The amount of inversion that took place really put a lot of people likely off sides. But in terms of where did it really rear its head, I'm not really sure. I don't have a good answer for that.
Yeah, we'll just have to see.
I was going to say, it sounds like another week of we're going to continue to monitor this, because these are spooky times. These are a little bit bizarre. I think you guys would agree with that.
And I think the VIX, like, that's really ominous to me, kind of seeing the way it's been rising and the fact that it's at all-time low levels when you have all these obvious stresses like the bond market. We were just discussing the inversion of the yield curve, and the VIX at extreme lows. Those things are incongruous, right? Like it shouldn't be that way. The VIX should be much higher, or those things should work themselves out. And we've kind of been running at this abnormal state for so long that it just feels like we're kind of on borrowed time here before something breaks in a major way, similar to like the COVID crash or something.
Yeah.
I pulled up the Bitcoin Parkinson volatility chart that you have made mention to prior, JJ. That might have been like a year ago by now, but that reading historically is almost the only time it was this low was in early January. That was right before the market sort of woke up from its bottom on the post FTX crash, and it hasn't been that low ever before that. In terms of, let's see, our data goes all the way back to October 2020. So the fact that volatility is this suppressed, is a kind of historical anomaly.
Totally flatlined.
The producer just chimed in, let me know that I wasn't doing my job, keeping the show on track. Okay, all right. So I get it. There's a lot more here that we could dissect. What I'm taking away is we're looking right now to see if the Dixie is going to get a pullback, give the market a little bit of a breather, but there's a lot more to monitor here. So folks, as always, I'm going to remind you, if you want to hear this, just as you did last week, you would have heard Ben giving you the down low on what we was expecting for Bitcoin, and it's basically played out to a T. You can follow me on Twitter. I posted that, but we'll definitely have to come back to the market update, but let's move on. Ben, I want you to talk about what's on your radar. It looks like you are looking at the U.S. Treasury general account that's growing, which sounds super sexy and interesting, but unpack it for us because I know there's a lot here.
There is nothing more interesting than talking about U.S. Treasuries and yield curves. Let's be honest here. And quick apology, because this is a crypto native show, and here we are talking about macro for probably the first 10, 15 minutes of the show, but we will bring it back. We promise. And in the state of the markets right now, with such a binary feeling, where either it's going to go parabolic or crash into the earth, I think it's important to monitor these macro moving topics such as Treasury. So to get to the point before these buzzers start sounding my headphones here.
Blame the producers. Blame the producers.
I'm shaking my fist at you, producers. All right. Okay, so the Treasury account at the Fed is loading up again. Now, just for a reminder, the U.S. Treasury general account is really what finances government spending, and it's housed at the Fed. And if we go ahead and look at it, back in early June, President Biden went ahead and allowed the U.S. to rack up even more debt by lifting the ceiling on that. So it's gone from less than $50 billion to over $500 billion in the last 2 months. The chart kind of shows that on Fred. But what's important, and the reason I'm bringing it up now, is that this morning the U.S. Treasury went ahead and what's the name of this thing? Quarterly refunding statement of Assistant Secretary for Financial Markets Josh Frost went ahead and issued some comments. I know, really interesting, but what's important to note is in the press release, they went ahead and said, based on projected intermediate to long-term borrowing needs, Treasury intends to gradually increase coupon auction sizes beginning with the August to October 2023 quarter. So what the heck does that mean? For those that have been following along, I've been expecting this to take place, so it's nice to actually see it in black and white right now, which is they're going to go ahead and start loading up on mid to long-term debt. And I have a table. I'll post it on Twitter. I'm pulling it up right now. It shows the May, June, and July auction amounts. And then it shows the expectation for August, September, and October. And what we see is that, relatively speaking, the biggest increase is happening in the 30-year. So it goes from what was July 18 billion to this month on the 10th, it'll be 23. So that's pretty substantial considering on the 2-year, it's going from 42 billion to 45. So why is this important? Comes back to the yield curve. So like right now, let's see what the 30-year is trading at. 4.2%. 20-year is right around there as well. Same with the 10 and the 7. But you go ahead and you look at the 1 month, 2 month, all the way up to, looks like the 1 year. We're right about 5.4 to 5.5, which is right near that federal funds level. So why am I bringing this up? Well, the yields are starting to rise on those 10, 20, and 30. And if you increase the auction size, so there's more debt coming into the market, you need to attract more buyers. And in doing so, you have more attractive yields. So this is just going to continue to normalize that yield curve over time. And again, a normal yield curve helps financial plumbing. Rates are starting to kind of go sideways here. And in such a weird binary type of feeling where the market can go parabolic or, again, down to zero, it's important we take note of this trend because this could actually be really good for asset allocation on the risk curve. So just keep that in mind.
All right. There was a ton to unpack there in the sexiness of the Treasury market. But now I guess you're giving us a little bit of some hopium. I'm going to pull up my little oxygen mask and put it on. That if we start to see this level out and normalize, you're saying you could see some renewed interest on the risk curve. Is that a fair statement?
Renewed interest, but also just the traditional economy in general is going to be kind of working almost as it's supposed to. And the Fed has wanted to do this for the past couple of years, and it's literally accomplishing what it has wanted to accomplish. I mean, I hate to say it and I hate to take their side, but look, inflation is coming down, and we kind of expected it because it went so parabolic through supply chains, but it's coming down. And everybody was saying the inversion of the yield curve was going to pose insane problems, and it did, right? In all fairness, it did with the banking, Silicon Valley Bank back in March, but that has kind of rectified. They went into the toolkit, pulled out the tools necessary to solve that problem. They went ahead, did it, and the yield curve is getting normalized. So at this point, they're doing what they set out to do. Now, will it work? Again, we don't know, but right now things are trending in a good direction.
Okay. That's some good news on a bleak day. I like that.
Do you think it's binary though? So high rates and high asset prices? Like, do you see that as being able to exist in a static state for long, or are we just kind of in this? It feels like to me we're kind of in an in-between period where we have that anomaly of high rates and high asset prices, and kind of just waiting for that shoe to eventually drop, which maybe is DXY going over 104 and kind of having a blow off top, or like eventually that the liquidity drain of all of these yields will manifest itself in markets, it feels like. And I think we kind of already see that, right? With the low liquidity, like we've been discussing just in the Bitcoin market alone, how little volatility there is because of the lack of liquidity. Like, I have a hard time believing that we could just kind of have that soft landing. Maybe, but I struggle to see it without some kind of blowback.
Yeah, it was in the press conference after Jerome Powell went ahead and made his remarks on the FOMC meeting and raising the rates. Somebody actually said, I forget her name, but she went ahead and said, looks like you're actually accomplishing your soft landing. He almost gave him a softball, and Jerome kind of took that and hit it. So they're patting themselves on the back clearly right now. And to your question, JJ, can we have high asset prices with kind of higher yields? When it comes to like historical examples of higher federal funds rates, that tends to be when asset prices do go parabolic, when those rates sort of normalize. Now, why does that take place? I don't really have a great answer, but historically speaking, yes, we can.
All right.
Well-timed
JJ,
buzzer.
great question, Ben. Okay, you came in there. You answered it quickly.
I got that shot in before the clock.
You did, right? The producers are in here. Again, they're nudging me to move on. So very interested to see how this continues to unfold if the engineered soft landing actually materializes. So something, again, of the many data points that we continue to monitor. But let's move on. JJ, I know you were talking before about the market update. It looks like you have some information here about the whales continue to do some accumulation, or if that's not the case, tell me what's on your radar.
Yeah, so a chart we mentioned a few weeks back, the whale divergence chart, and it just kind of shows the net accumulation or distribution from whale wallets. So that would be, I believe, wallets holding over 10,000 Bitcoin, tracks them on a daily basis, and you'll see a red dot if they end up with a higher average at the end of the day than they had at the beginning of the day, and a green dot if it's lower. So what's interesting is that since April, it's just kind of been this huge accumulation channel. There's been a few days where we see green dots, but the overwhelming majority of days have been red dots, signaling that whale wallets are on net, adding to their piles of BTC, and they've been adding even above 30K. They've had multiple days of purchases there. And again, we don't know why. So that triggers my reaction to wonder, like, for instance, we saw this prior to the ETF filing. I'm guessing some whale wallets were in the know of that and kind of started to front run it in that instance. And I wonder what could be front run here, or if they're going to end up capitulating out at a lower price. Historically, we typically don't see whale wallets buying high and then selling low. So this could be one of the rare instances of that. That's always a possibility. But I'm inclined to believe that they're smart money for a reason, and that they're betting on higher Bitcoin prices in the near future. So kind of all of the macro headwinds and the possible doomsday scenarios we were just outlaying there, you have to counterbalance that with the fact that there are a sophisticated amount of high net worth individuals betting on higher Bitcoin prices, and factor that into the equation one way or the other, because it is a valid data point in my mind.
Okay. So again, bringing on some hopium, we maybe have the return of the normalization of the yield curve with whales who have a long time preference being able to accumulate low and sell high. Does that sound
They
about
seem
right?
happy to buy in this 27 to 30K range for whatever reason. And typically that'll form like, it seems like this is just an accumulation channel, and you'll see this go on for months, and then we'll kind of make a leg up. It doesn't seem like we're gonna get that leg up right now. Granted, we're at 29.3. Things look rather bleak, but again, we don't know the future. Somebody may be in the know of this, and maybe the DXY reverses. We see it go below 100. We have that blow off top that we were discussing about a month ago. Remains to be seen, but it seems like they're positioning for that kind of scenario. So worth keeping an eye on. For sure.
Yeah, absolutely. And one, I guess a theme that comes up on the show a lot, at least in my mind, when we're discussing this, we have sort of this near-term, medium-term, and long-term horizons where the audience, if they're thinking about trading and they hear an update like we did the market update, it's really about positioning. If they're looking to get into positions and exit positions within the next week or so, versus, when I look at this chart, it's really where are you positioning for the next 18 months or 2 years in my mind. And maybe it doesn't have to be that long, but when you look at whales, they tend to have a longer horizon. So if you're trying to track what they're doing, it makes sense that you're sitting there saying, okay, this is, as you said, an accumulation zone at a point where I can sell out later. I'm not necessarily looking to trade this on the near term.
Right. Yeah. When you're moving in that kind of size, you're not typically doing it in like a day-to-day fashion. It's more multi-week, multi-month, and that appears to be what's playing out here. Is they've been buyers since mid-April or so.
Yeah.
It kind of feels like cycle buyers, right? Like these are the ones that are playing the 4-year move.
Yep. Front running the halving.
Yeah. And you got that short term kind of week to week. And then that 90-day period, I think, is where there's always a lot of question marks.
Mm-hmm.
Yeah. And with liquidity drying up, how do you see this playing out? Do you expect this chart to change at all, JJ? If we could, because we have talked about liquidity just being very low for a long time.
That's the thing, is that so they, as I was saying before, there's been very little spot volume in markets basically all year in Bitcoin, essentially since March, especially since March. So the fact that there's this much supply concentrated in whale hands means that the market is very easy for them to manipulate, right? And kind of the way I look at it in my mind, maybe I'm a bit conspiratorial, is that they're waiting for one side of the market to get completely offsides on perps and then just blow it out with their spot holdings. So if everybody, you kind of keep price in this boring range and everybody steps in on perps to either long or short, very easy to manipulate the price against them with their spot holdings, and you either sell into it or buy into it and cause a squeeze one way or the other. Then you buy or sell the liquidation points. And I think that's coming. It's just a matter, I think Ben's been pointing to that spot CVD chart multiple times. So eventually we will see that. And I expect that's when we'll see these holdings change one way or the other once we get kind of a violent move in either direction there.
All right. Again, something to monitor, and with great data, this one coming from Jarvis Labs with the BTC divergence. So I suggest y'all come back next week so we can continue to monitor this. JJ, thank you. Let's move on to the like it or spike it. Kodi, are you in the house?
Here I am.
Hey, you're a little faint. We need to, the producers are asking you to get closer to the microphone.
Is it better now?
Oh, that's better now. Oh, there's a soothing voice of King Kodi. All right, we've got 3 of these today. It looks like. I want to hear. Are you excited to give us your breakdown? We've got some hot topics here. We've got Bald, we've got Viper, and we've got Curve. All 3 of these sound very combustible. You ready to go down the list?
Let's do it.
All right, I'm excited. Okay, Bald, a meme coin worth 100 million at its peak on Coinbase's new base chain gets rugged. Like it or spike it?
Spike it. So for those that don't know, Coinbase released a new chain. It's basically an L2, and it's built on the Optimism stack. Sorry. So they released it last week, basically, and there was nothing going on until someone decided to create a meme coin, which is called Bold. Why is it called Bold? It's called Bold because Brian Armstrong is bold, and apparently people find that very funny for some reason.
I find that very harsh, but go on.
Hey, I didn't choose the name. So yeah, this guy deployed Bold, and then he started adding liquidity to the pool. There's like this Uniswap clone on Coinbase on Base, called DXY. So he started adding liquidity to this pool, and usually if a token has a lot of liquidity, that means that it's going to go up because liquidity begets volume, people get interested in it, yada yada. So whenever it seemed like people were losing interest, he would just add liquidity to the pool, and people would be like, oh, there's something going on here, there's something going on. And people just started bridging into Base, even though right now there's no way to bridge back. So people were just like, I don't know, like willing to move to a new chain that hasn't been around for even a couple of days to just buy a meme coin.
Locking
so after a
themselves in a
couple,
burning building.
yes, I don't know what's going on, but yeah, after a couple of days, the guy decides to stop adding liquidity, and the price stalls. And realizing this, he's like, "Oh, let's spike some interest again," and he just starts buying like massive clips of gold, like millions at a time, which obviously moves the price up a lot, and people start buying again and adding liquidity to this pool. And at some point, he just withdraws all the liquidity from the pool and gets himself a good $2 million for his efforts. No, sorry, $5 million. It's just not too bad for, I don't know, a few days work. And as far as I know, he's still like kind of trying to rack people. He's saying that like he will add back liquidity and like direct all profits to a non-profit organization. I guess he refers the same non-profit that FTX had. I don't know. This is I don't know how to describe it. I can't.
I think the easiest description is scam and rug pull, and anything associated with the FTX, I think, has the worst stink on it of anything in the marketplace. I can't imagine someone actually believing this. Are you buying that he's going to put some of this money back into for a charity?
I would just tell him if he sends me some of the profits, I will say that I buy it. Yes, but
okay. You're becoming part of the mechanism, the scam. I see.
Hey.
Okay.
Man's
all right. Okay. Well, yeah, I don't know. That's a bad one. I'm glad you spiked it. If you had said anything else, we may have figured you were already on FTX payroll. All right. We ready to move on to number 2?
Yes.
Okay. All right. A bug in Viper's compiler causes. Rephrase this. A bug in Viper's compiler allows attackers to drain a number of curve pools. Like it or spike it?
Spike it. Okay, this is a bad one. What happened? Well, let's recap. Viper is one of the 2 main languages for Ethereum or any EVM chain. Most people use Solidity, but a number of DeFi protocols, amongst them Curve, use Viper, which is Pythonic or similar to Python for those that use that language. But anyhow, the compiler is of a language is what makes the code that you write run, basically. So you write some code and then the compiler is the responsible for making sure that the code can run and then running it. And the issue is that most auditors, or basically no one, is looking at compilers. So if they're like people and engineers and auditors just assume that compilers are well written and that they do not have any bugs. So most people are not looking at those. So the fact that there was a bug in one of those is quite bad in and of itself. We do not know yet who attacked the curve pools, but it was likely a state actor. These bugs take a while usually to be found, and this is in again a language that most people do not know. Viper is not nearly as successful as Solidity, so there's not many people working on it. There's not many people that understand it, and there's even less people that understand the compiler. So the fact that someone took the time to go through all the previous releases of this compiler, because this was found in an old release, is quite bad. It means that people are likely, or like state actors, aka it's mostly North Korea that has been behind this, and the Lazarus group, they are not being able to find bugs in new smart contracts being launched, and they are turning their heads to compilers, which is even worse because they are likely starting with Viper as it's a smaller set of releases that they have to go through to find any bugs, but they will probably start looking into Solidity next. And it's quite likely that there's some protocols out there that use previous releases of Solidity that have some bugs, like it happened for these curve pools. And we might see some nasty attacks here on out. This one was, I think, 60 million worth of stablecoins mostly that were taken from curve pools. And those pools have been stopped, all the ones affected. But yeah, it's not good.
Yeah, so that's definitely a scary risk for anybody who's got funds locked in any kind of smart contract, because it requires technical knowledge to go back and look at the compilers and to understand what the vulnerabilities are.
You're not supposed to understand it as a user. That's
right.
what's even worse about this, like if I'm gonna use Curve, I'm not supposed to be able to understand the Viper compiler and be able to like, oh yeah, I think there might be a bug in version 2.05, but not in 3, which most Curve pools use anyhow. Like most of the pools that most people think of when they think of Curve, like the 3 pool, the staked ETH and ETH pool, those are not affected. They were quote unquote minor pools, but it was still $60 million worth of crypto that the attackers got away with.
Yeah, I hear this, and what comes to mind, just screaming in my head, is these are growing pains, and this is an area where the community has to rise up and get a lot better if we're expecting more and more people to join the space and to trust it.
Absolutely, yeah.
So
the good thing about this is like this will likely make so that a lot of people start looking into Viper and more people start working on the compiler and security for Viper, which up until now there weren't that many people working on, unfortunately. So yeah.
Got it. All right. Well, we've got one last one here. Let's see if you can give us some hopium this time. Although looking at the headline, doesn't exactly appear to be the case. All right. Curve CEO Michael Egorov, I didn't pronounce that correctly, so you can skewer me all over social, uses 43% of CRV circulating supply across DeFi for loans. After the Curve exploit, the price of CRV dumps and its positions are in danger. Like it or spike it?
Spike it.
All right, throw it down. Again, you got you're 3 for 3 today. Give us some more dread.
It's been a terrible week on chain, but yeah, this guy is one of the founder of Curve, the one that controls most of the supply, and he has used 43% of all circulating supply to take loans in AV, in Frags, in Embers, worth almost $100 million, and he decided. At least we don't know he used it for this, but like it was also news not that long ago that he had bought 2 mansions in Australia worth north of $60 million. So I don't know. It might be that they are related. Anyhow, he doesn't control any significant crypto aside from Curve. So the only way for him to try to repay those loans or like to not be liquidated is to just send some more Curve to Aave and the other lending protocols, which he has already done in the past. Like 2 months ago, maybe we discussed it, how he almost got liquidated, and now again we're discussing how he almost gets liquidated. It's likely that at some point the price of Curve goes below his liquidation point, and actually it did during the Curve exploit. The only reason he was not liquidated is because the Chainlink Oracle that most DeFi protocols use relies on centralized exchanges, and in centralized exchanges the price of Curve didn't go down as much, but if they had been looking at decentralized pools, he would have been liquidated by now. Anyhow, he has found some way of getting a timeout, which basically is just sending people like Justin Sun and DCF God and DWF Labs, Sifu from Abracadabra and that whole debacle. He's sending them Curve and valuing it at $0.4 instead of the 0.6 that it's trading at right now. And the understanding is that it's vested 6 months. It likely isn't. Someone already sent some of that to Binance. They haven't sold any yet, likely because there is no liquidity. Or like if people see that they're starting selling, everyone is going to start selling Curve. Like this will creator. And yeah, like you have one single person, the CEO of or founder of Curve, but like one single person basically putting in danger most lending protocols in DeFi just because he wanted to take some loans using a coin that he created by himself. It's not great.
Yeah, this, I think about a couple of weeks ago, we talked about a actor turned activist who had put out a new book and was criticizing the crypto industry. This to me seems like a legitimate criticism. I mean, when we talk about decentralization, we talk about the value of DeFi. When I look at this, we have a central party that's built what appears to be an actual valuable protocol, but is using it in a way that puts, as you said, the entire community, the entire DeFi ecosystem at risk, which then begs the question, how is he allowed to do that? What allows them in this permissionless environment to create this kind of risk?
I don't know. This is a fault of the lending protocols. They didn't consider the risk of someone using as much of the circulating supply when taking out loans. They should have set caps for that Curve. They should have taking into consideration the liquidity that they might have when they have to liquidate the loan, which they didn't. I don't know if I guess there's a risk department in Nava, but I don't think they were asleep at the wheel, basically. Or maybe they just trusted the curve guys to not be malicious. Like I don't know if it's like, oh yeah, we know this guy, like we might let him do this loan, even though we probably shouldn't. Like Gauntlet and Chaos Labs, which are two risk shops, let's call them, these research companies, they recommended not to allow this and basically to put caps on the amount of CRV that Michael Agrove could borrow. And these DeFi lending protocols, they just didn't listen. So now, yeah, we're faced with this.
Well,
and then you got Frax too, right?
Yeah, there's Ava, there's Frax, there's Inverse, there's
but they're actually looking like almost, better risk managers than the other two.
Yeah. Frax was they managed to do something so that the amount that is lending through Frax was lowered. But there's still like a sizable position. Last I checked, it was like $9 million worth of Frax borrowed. So almost 40 million of Curve in Frax. But yeah, that pool or like that loan looks healthier right now. But the other ones don't look nearly as healthy. And from last time we checked, he's even put more Curve tokens in these lending protocols. So it just feels like whenever he gets some more Curve, he just distributes it through the lending protocols that he's using to try and maintain his loans from being liquidated, or he's like shuffling around from one lending protocol to another. Like he took some of Frax and he sent it to Aave or whatever. It doesn't look like he will pay. Like I don't know, and unless he sells his houses, which I don't think he will. Really. I don't see how he pays back these loans unless a bull market comes back.
Yeah, he's holding on for that bull market, which I think is a little bit of a ways away. All right, so I think we got the lowdown on Curve, and actually we have a bonus one. I said there were 3. There's actually 4. Kodi, you're the king that keeps on giving. We got one last one here. Let's see if you can bring in. I like it. I don't know. Justin Sun introduces staled USDT, STUSDT, the first RWA project on Tron. Like it or spike it?
I like it.
Thank you, Kodi. All right. Expand.
To be honest, I only like it because Justin Sun is, I don't know, he's so good at this game. He's like, as I said, like the Michael, the co-founder of Curve, had sent some Curve to different people in exchange for, in exchange for money, basically. He was selling it at $0.4 instead of $0.6. Justin Sun apparently also managed to get a new Curve open for his new project on the deal, which is quite, I don't know, he's good at like playing his hand basically. And what is his new project? Basically, as everyone is trying to release protocols to get the yield from bonds on chain, Justin Sun is doing the same just on USDT. So most people are using Ethereum or Polygon and getting the yield from US bonds and trying to channel that to KYC individuals and whatnot. Justin Sun is like, hey, I'm going to give you 4.3% APY on your USDT. You just have to come to Tron, put your USDT in this pool. I'm not going to tell you what it's backing it. I'm not going to tell you what's behind it. I'm not going to give you any docs or anything. Like, that webpage looks sketchy as hell. But you're going to get your 4.3% APY. And it's managed to get like $430 million in TVL so far. It might be that it's Justin Sun's money, as with all his projects. We never know. But yeah, for now, it's the real world, or like the tokenized bond protocol with the most success so far. Again, it might just be his money. But yeah.
All right,
at least he got a good play out of it.
This one. You gave me a like it after the dismal 3 that you started off with. So I'm gonna say I like that. That's good enough. The concern I guess anybody should have is when you're looking at these opportunities is exactly what we said. It's opaque. We actually don't even know what's backing it. But to your point, Justin gives us a little bit of hope because he's very creative.
Yeah, to be clear, I'm not liking the project itself. I wouldn't trust staked USDT. I wouldn't trust Justin Sun. but I do like the play that he's doing. He's using this I don't know how to call it, this crisis in curve to try and get more exposure to his project to stake USDT. So hey, it's a good play.
Yeah, hey, it's the man obviously knows how to market. Okay, all right, Kodi, thank you. We got 3 spike it's, 1 like it. I suggest you come back next week. Your track record's looking pretty good. I was reviewing your old like it and spike it's, and they're looking pretty good. At some point, we'll release that to the wild, and then we'll have you comment on that. We can come back to it. All right, but for now, let's move on to a deep dive because we have 2 topics here I think that are interesting. I want to get your guys' take on it. So the very first one, and Kodi, I'm going to keep you in the hot seat. US IRS, excuse me, clarifies the staking revenue is taxable. And there's a lot of discussion on crypto Twitter about the impact of this. I think the thought was most people expected for it to be taxable in some way, shape, or form. So perhaps they were preparing for that. I would imagine a lot of people more on the degen side don't care. They just assume they're going to be able to fly under the radar. And I think those days are numbered. I guess, Kodi, from your perspective, when you see the U.S. government and the IRS coming out saying staking is a taxable event, is your perspective, is that going to put sale pressure on Ethereum or any chain using proof of stake? But specifically, if we look at Ethereum, what is your thought process on the impact that might have on the people that are holding it and how they're going to be paying those taxes?
So I think it's going to put some sell pressure for sure. We already do see some weakness around the time that U.S. Individuals have to pay their taxes and whatnot, and this won't help. I don't think most people are going to care that much through the year, at least. Like if it is a taxable event, I'm not sure if it's in just yet, but if it is, I don't think your average Joe will likely care until it's his turn to pay, and maybe he gets bad news from the IRS and he realizes that he owes more money than he thought he would. But yeah, I don't think most people are gonna look into this. As far as what would make sense to me is that you would have to pay taxes on your capital gains, or at least only based on the price of Ether or whatever the asset is at the time you sell it. What they are proposing is that you both pay an income tax for based on the price at which you receive these rewards, and then an extra capital gains tax based on the possible capital gains that are the possible changes in price for the asset, and until you eventually sell. So
yeah, it seems like double treatment.
Exactly.
For crypto, right?
Exactly. And I think more than create sell pressure, it might hit on the thesis that Ethereum, it might hit on the thesis that Ethereum has this source of yield equivalent to US bonds. If that is taxed as income, I don't think it plays as well. What do you all say?
Right. No, I think that's a good perspective. Ben, I want to hear from you because you've talked about this, looking at Ethereum potentially becoming the pristine collateral and maybe creating a yield curve in crypto. Kodi just mentioned that it may actually help with that potentially. What's your perspective on this tax clarification? Let's be clear.
To be clear, I said that it wouldn't help.
It wouldn't help. Okay. All right. Sorry.
Yeah.
Misunderstood. King Kodi's coming out here swinging. Ben,
tax days in April. And I think one of the narratives that are now going to happen for April, if this holds true and continues to kind of be the regulation that everybody abides by with the IRS and gets adopted by really kind of crypto accounting software, because that tends to be one of the most used pieces of software in crypto. But April would be a sell event just because having to pay for taxes. And of course, in December, that would probably be the same thing as well for likely larger entities that have an accountant that's helping them kind of balance their sheets. But one thing I find interesting is to bring up an old news event. So this was, I think it was almost 2 years now, maybe it was a year and a half ago, but there was a couple, I think, from Tezos that was receiving staking rewards, and they started to refute some of the taxes that they were going to have to pay. And they actually won the case. And what that was saying was that because they never went ahead and redeemed those staking reward. They didn't have to go ahead and pay yet, at least. And one of the things that CoinTracker, who is another crypto accounting firm with their software, what they actually stated was that it's too early to say when staking income should be taxed or if you can even rely on this case. So it was just interesting to hear that at that time. And then now we have the IRS releasing these rules, but then now you're sitting there based upon the current discussions on whether these tokens are securities or commodities, and it looks like it's leaning towards commodities. And unfortunately, I think somebody had a coffee spill in the lab, so JJ had to go ahead and attend to that. So he's not here to give us those wise words that he actually told us before the show, but it was he was bringing up, orange groves, and when the tree is growing the fruit and it's blooming, like you don't actually have to pay taxes at that time. It's when you go ahead and sell that produce, even if you don't go ahead and do additional production on that piece of fruit, but when you sell it, that's when you're taxed, and that's that taxable event that you go ahead and file with the IRS. Now that's a commodity. Are we going to be treating these tokens now as securities or commodities? I think this sort of thing will renew that debate once more. And if anything, it just continues to muddy the muddy waters. And it's like, come on, let's go ahead and cement all these things. But having so many various regulators trying to put their hands in the bucket, like we gotta sort this out.
Yeah, I think that's a great cap on that discussion. We've got to sort this out. A lot of this comes down to lack of regulatory clarity. And of course, you're going to have different regulatory clarity in different jurisdictions. So my hope, and I imagine for you as well, Ben, or anybody listening, is that the U.S. and other regimes start to at least give the clarity that people need to know what they're facing in terms of tax implications, as well as just being on the right side of the law. It's completely up to you on how you want to operate, but having that clarity, that line of sight is important.
I'm not an accountant, I'm not a lawyer, and I just like to look at what it means to price, and what this comes down to is based upon what they do. Like, is December going to be the sell event, or is April going to be a sell event, or is it just going to be a constant sell pressure throughout the year? Like, these are good things to know. Yeah,
excellent things to know. All right, Ben, you put out an article this week on Brenton Woods 3.0. I just want you to revisit that. We've talked a little bit about it on this show, but can you just give us the highlights again? Because I reread it last night when it came out, 2 a.m. Remember, I have a baby. And it really dawned on me sort of the impact of technology on the financial system, and really your perspective on how that can dethrone the dollar. So can you just give us a quick recap?
Sure. I will try to make this short, but that's a tough topic to do it quickly. But when it comes to Brenton Woods 3, this idea is really about kind of the erosion of the U.S. dollar's dominance as a reserve asset and currency. And this kind of came into fruition when we saw Ukraine and Russia go at it. And then we saw discussions with China and Russia having these agreements, and then various barrels of oil markets now priced in the Chinese yuan or renminbi. And these discussions continued to happen over time. And what this was all about was that the U.S. went ahead and used the U.S. dollar as a kind of financial warfare, being able to close down the usage of one's U.S. dollars on their balance sheet. This kind of lost trust in holding that asset on the balance sheet, and now it's all about countries trying to get the most natural resources out of their land. And that was Zoltan Pozsar's thesis. But the way that I kind of started to look at Bretton Woods 3 was a little bit different, because you got the Bank of International Settlements, Monetary Authority of Singapore, and a couple other very small projects. I mean, when it comes to New York Fed, I believe the Cedar Project is one that you have to watch out for. But these projects are using DeFi primitives, and what they allow is foreign settlements to take place without the usage of dollars, which means less demand for dollars and less need to hold dollars on a central bank's balance sheet. Anybody who's been in crypto kind of knows what that means is you don't have to have that dollar in your wallet, or you don't, with ETH, you always need ETH because you got to pay those gas fees. But if that's not required, then you don't need to hold ETH in your wallet anymore. And that's kind of what's happening with these projects. Once they go out into the wild, you're not going to need the US dollar as much. And for an asset that was almost 90% of all foreign settlements, it was 80 some odd percent, that figure is going to go down. And so for me, sitting here wondering what this means for the dollar and global finance, like this could be a massive inflation event when these projects actually roll out. The dollar is going to lose purchasing power as a result.
I'm a little bit stunned when I start to think about the implications of using DeFi primitives to usurp the US dollar system. And it seems to me logical that other governments would be frustrated by the way the US dollar is weaponized. And so they would be looking for alternatives. So there's a lot to discuss here, a lot to unpack. We don't have the time today, Ben. I'm going to want to bring you back for sure. Probably do a show just on this topic because there's so much meat. But give me just like 30 seconds to a minute. What are you looking at to get a better understanding of how this may unfold? Are you looking at projects that are coming out from the BIS or from local governments? Are you looking at just where they may be experimenting with DeFi primitives? What exactly do you think is on your radar as you're trying to see if this thesis is going to unfold as you expect it to?
Well, really 2 to 3 things. The first one is kind of what the narratives around the Fed now is and how the uptake of that is, and if they're actually preaching that to be successful, right? Like that's one of your signals. Second one is when these things actually roll out. They're doing experiments right now. They're doing wrapped CBDCs to allow for that swaps to happen. Do they continue to talk about it in all their speeches? I mean, right now they are just blasting their channels with tokenization and kind of the digital future of money. So that narrative that continues, like this is happening and you need to be aware of it. But what I want to see is somebody actually discuss what this means to the US dollar when these things start to unravel. And I haven't seen a single piece of paper talk about it. And when that happens, when somebody actually goes ahead and addresses this massive elephant in the room that's sitting there, and they have to know about it. But once they do, is there a pivot? And what is that pivot? And that's what I'm going to be watching out for.
All right. Looking for the pivot. I love it. And as I said, Ben, I'm going to want to bring you back probably on a solo show just to really unpack this. So more to come on that front. All right. We've got the last segment. We've got the roast. This one's a little odd. I want to hear from you guys what your thoughts are on AI and aliens. So you got to put on your little conspiratorial hat, maybe a little tinfoil if you need it. But there's a lot of discussion. There was actually a great piece in CoinDesk. I can read a little bit from it. It says, now, dear CoinDesk reader, you may be wondering what UFOs or talk of non-human biologics and physics-defying tech have to do with crypto. Well, in short, it doesn't. I'm sort of banking on the crypto community's inclination to speculate to hold this piece together and your attention. But I mean, isn't any example showing that authorities cannot be trusted another notch for blockchain a reason to build tools that empower individuals? So this article goes on to talk about, are aliens would they be using blockchains? Would they be using cryptos? And I thought it'd be a fun question to ask you guys. And then it got me really thinking about something that's probably a little closer to home, which is, are there cryptos that are going to be used by artificial intelligent bots? So Kodi, I'm going to start with you. If you had to decide between BTC, Ethereum, or something else, which of the blockchains or which of the cryptos do you think is going to win for our AI robot overlords?
I'm not sure for our AI overlords, but for the aliens, it must be Atom or Cosmos. Like it's literally in the name.
All right, I like that. Atom or Cosmos, because you're saying because it has a reflection of the environment that they already know?
Yes, and because I have underwater atom bags and I need someone to buy them.
Second that.
Okay. All right, Ben, I'm going to ask you the same question. Let's just start with the aliens. Which chain are the aliens going to take? Are they going to take BTC, Ethereum, or something else?
Oh, man. I was going to say for the AI at least, it's probably going to be Tron because I feel like there's already so many bots already on that network.
Ooh. I like that. Calling out for what it is. All right, so Tron for the AI. What about the aliens?
Well, I think I have to lean towards Ethereum at the moment. It's becoming the single source of truth. And in a world where we're starting to see images with 6 fingers and that kind of be the glitch in the matrix that's existing in our future world. And based on our graphic design department, they had images that were produced by the AI and you could tell there was again, that glitch in the matrix happening. We're going to need that single source of truth. And the Ethereum right now has the most data providers, analytic platforms, and all the tools necessary to sort out what that truth is.
Okay. Kodi, any response to that? All right,
please spam my bugs.
What's that, Kodi?
Please spam my bugs. Yes, Ethereum's cool. But
sorry, I meant Atom, right? Cosmos.
Yeah, there we go.
Thank you.
Is that better, Kodi?
Just so we're clear, yeah, we're trying to help Kodi out. All right, well, since JJ's no longer here, as you mentioned, he had to go clean up a spill. I'm going to put out my vote, and I am going to have to align with Doge because King Elon, who's trying to be interplanetary, may in fact already be an alien, and we know that he likes to pump the Doge bags. So That's my vote. And that at least is for aliens. And for the AI, I'm going to have to go to WorldCoin. It's already concentrated in the hands of people that are most likely robots and alien and AI already. So I think that's going to take over.
Can we get a dog bark from you, Marconi?
Rough. That's the best I can do today. My producers did not outfit my sound panel well enough. I'm going to have a conversation with them offline. But guys, that's going to do it for this week's show. I'd like to thank this week's guests for sharing their insights. We got Ben Lilly, we got Kodi, and JJ was here, so give him some love out on Twitter. And if you want to hear more of these insights, you can't wait a week. I totally get it. I would suggest checking out these guys on Twitter. That's where they're going to be sharing a lot of their alpha during the week. And also, if you haven't already, you got to sign up for the Espresso newsletter because that's where they're going to be sharing a lot of their ideas in long form. And here we're just trying to take some of those ideas, bring them together, and give you a little bit more insights to what you may be getting from those articles. Lastly, I will say we continue to work on the video. I'm amazed at how complex it is to set up the video. My producers are doing their very best to bring that to life. We are super excited. We had, I don't know how many charts, I can't even count them, that we're going to be putting into the broadcast, get you some better insights, because I know everyone that's been asking about that wants to actually see some of the data. That is on the way. Hopefully in the next couple of episodes, we can start to drip that out and you can actually see what the video looks like. So more to come. Suggest you check out, or rather you hit the like and subscribe button so you can come back and be notified when that is live. And for now, be safe out there. Have a good time in the cryptoverse. I know it's kind of a boring time for many. We started off the show that way, but stay strong. Better days are ahead of us. And for now, and until next week, this is Marconi White signing off.